Welcome to the market segment. Most Asian markets ended the day in positive territory as they followed strong performances in the United States and other markets. Another positive for markets was the fact that the non-farm payrolls report showed that U.S. jobs created in April were fewer than anticipated, which gave rise to speculation that the Fed may cut rates in September. While the Japanese yen lost some ground against the US dollar, the Japanese market was closed for a national holiday today. Over in Hong Kong, the Hang Seng Index ended the day up 0.55%. Mainland China saw investors flood back into the market from the May Day break, playing catch-up with the global rally, with the Shanghai Composite Index closing up 1.16%. Over in Wall Street, it ended sharply higher, boosted by the 10-year U.S. Treasury yield easing. Markets also climbed after data showed U.S. job growth slowed more than expected in April. Analysts say this will take the pressure off the U.S. central bank to keep rates higher for longer. The S&P 500 gained 1.26%. The Nasdaq Composite gained almost 2%, while the Dow Jones Industrial Average rose by 1.2%. Well, locally, the JSE is green across the board, with the all-share index climbing 0.8% at 77,317 points. Markets in Europe are higher following the trend, with Britain's FTSE 100 up 0.5%, the Paris CAC up 0.7%, and Germany's DAX is 0.4% firmer. Looking at commodities, gold is trading at $2,320 and platinum at $973 an ounce, while the price of Brent crude oil is trading at $83.72 a barrel. The rand is trading at 18 rand 41 cents against the dollar, 23 rand 16 to the pound, and 19.88 against the euro. All right, well, for more on the markets, I'm joined by Roy Matun. He's a portfolio manager at Sanlam Investments. Thanks very much, Roy, for joining us. So there seems to be some positivity in global markets. What's your reading of what's happening and the drivers behind it? And also give us your reflections on what trends you saw in the month of May in both global and local markets.
Hi, Norm. Thanks for having me. So it seems like the market is getting comfortable with the fact that in all likelihood, the U.S. economy is not overheating, and inflation may come under control at some stage this year. So there's a little bit of risk on, and that's coming across most markets, as you mentioned in your introduction. So it seems like it's positive. Let's see how that pans out. If I look over the past month, actually, it was quite an interesting thing. Unlike prior trends, you saw emerging markets, and especially South African markets moving up, while developed markets sold off a little bit. You may recall at the beginning of the month, there was this whole thing that we'd seen the US economy really growing strongly, employment was still strong, and there was a perception that maybe the Fed would need to be a lot more hawkish, so the dollar was a lot stronger, and that was probably why markets were pulling back. In South Africa, we saw a bit of corporate action, the gold price rally, and all of that just added into much stronger markets here. Not translating into really strong SA Inc., but in aggregate, you saw the market moving up over the month. I think when you start looking forward, clearly for this month, there's going to be a lot of speculation around the election, and that's going to drive a little bit of volatility. But I think the whole market is just positioning itself and hoping to see a positive message coming out of the election that comes out at the end of this month.
Yeah, of course, the conversation that's been driving markets since the beginning of the year is really, when are we going to see interest rate cuts? There's a feeling after that data, that non-farm payroll data showing that US jobs didn't come in at the level expected, that perhaps the Fed could start cutting rates as early, well, not early, in September, because if you consider earlier, the market actually expected that the first rate cut would take place in March. What are your thoughts around this?
So the way to think about this rate cut, will he, won't he scenario, is that there's two reasons why you'd cut rates, two opposite polar reasons. The first one would be that the economy is growing at a reasonable pace and inflation is at target levels. Then what you would do is you would manage your interest rates downwards. The other way, which is what I don't think anyone wants to see, is if the Fed looks up and says the economy is actually slowing quite aggressively, Inflation at that point really doesn't matter. It's that growth becomes a challenge, so they have to cut aggressively. The markets will react positively to the first and negatively to the second. And with each bit of news that comes, the picture becomes clearer. As it stands right now, it seems like we're almost in that Goldilocks scenario where inflation seems to have bottomed out. Growth is still relatively strong, but getting softer, so becoming less of a threat to the Fed's ambition. So when the Fed looks at the picture, they're saying, actually, we don't think we need to hike. In all likelihood, we will need to cut, but it won't be because the economy is crashing around us.
Yeah.
And this game will continue for the next few months, as we see. And remember, they're only going to talk to us after another inflation print and after we've seen another non-farm payroll. So they'll have a lot more information to inform their decision then.
Indeed. Looking at a local stock now, one of the things that we're always told is that it's very important to look at the management of a particular company that's listed if you want to invest therein or you're already invested. One of the companies that, of course, we look at a lot is Sasol. We heard that the CFO, the Chief Financial Officer, decided to resign, and he's not been there anything nearly 2 years. How worried are you about Sasol? We know that there is some leadership changes at the CEO level as well that are going to take place if they haven't taken place already, because that stock seems to be really suffering, trading around the sort of 130 Rand per share level. This is a stock that once traded around 400 Rand a share not that long ago.
Yes, it's an interesting thing, and I guess the rule of thumb in markets is when the FD does go, you have to check your numbers and look at the company. But in this case, I really don't think that's the issue. Yes, there have been management changes, and there's been more management changes if you look back over the past 2 or 3 years. But the thing about Sasol is there's a lot of bigger macro issues to deal with. There's ESG, there's the whole issue around gas, there's the whole issue of them generating, of how solid their cash generation is. There's the chemical cycle as well. So I think the questions to be asked around Sasol completely supersede the change of one specific individual. There's nothing that we're hearing that it's connected to the performance, to his performance, or to the performance of the business, and I don't think there's much of a question around fraud or anything of that sort. I think it's these more macro and operational issues that are weighing on the stock as it stands right now. Like you said, it's probably at a very low level compared to the heights that it had attained historically, but I think only a resolution of these operational and macro issues will see this stock price re-rating.
Yeah. Thanks for that, Roy. So over the weekend, there were reports about Shell possibly leaving the country. With everything that you've seen with the companies, the many companies deciding to delist from the JSE and, or sometimes deciding to move their primary listing to other jurisdictions like the London FTSE and so on. And with, a divestment taken out by some companies in the recent past, how concerned are you around South Africa's fundamentals and its ability to get investment?
I think when these things happen, a certain level of introspection is warranted, but I think as well, it's important to look at the bigger picture. These big multinationals continually change their strategies and change the directions they're moving to. So for instance, with regards to Shell, if you look at a lot of their disclosure, a lot of their recent disclosures, they've been retreating away from downstream businesses globally. And that's the business that they're involved in now, here in South Africa. I think the refinery closed, so their interest, the level of interest has actually come down. So maybe that is a driver of what's happening. With regards to delistings, it's not a pure JSE thing. You've seen that in all stock markets globally. The number of companies coming out, being bought out, and maybe that was more a function of cheap money out there and a race by private equity companies to bring down, to delist listed companies. So it's not a pure JSE thing. There are certain things that may be SA specific, but I think by and large, we are a victim of global trends, a move towards developed markets rather than emerging markets. Because if you think about it, all of these big companies came to emerging markets when the promise of growth was there. But in the last 10, 15 years, we haven't seen much growth in emerging markets. And I think what you're seeing from multinationals is a continued a need to withdraw and rather maintain their management structures in developed markets which have outperformed, and then handle emerging markets almost on an arm's length basis, and manage their businesses in that way. At the end of the day, their primary responsibility to their stakeholders is to earn a return, pay a dividend, and grow shareholder value.
Yeah, indeed. Thank you so much for that perspective, Roy. Roy Matun, he's at Sanlam Investments. He's a portfolio manager there.